Greetings. Keith Prather here with the NCM Automotive Demand Outlook for January. Let me go ahead and share my screen. Very quickly, the Automotive Demand Index is, again, one of those indexes that we put together that helps understand what the demand looks like moving ahead. So when we look out 2 to 3, even up to 6 months, this will give us an idea of what we would expect consumer demand for vehicles, fleet demand for vehicles, what that environment looks like. So we came in just a little bit higher. The latest data that we have when we compile all the economic data is from November, and we got about 3.2% higher demand signals in November than we did in October. It's still a little bit lower year over year, but we're watching overall as just this range of where automotive demand is. And so again, weaker than what we had maybe coming out of the pandemic, when obviously we had a lot of sales, we had that surge in buying opportunities in 2021 and kind of early 2022. And then we kind of fell back off into what was a little more of a normal demand environment. And that's kind of where we are now. A little bit weaker than back in the cash for clunkers period, but right back to where we were just pre-pandemic. So it's feeling a little bit better. Now we also have a forecast for automotive vehicle production. And this forecast is on the industrial production side of the industry, but it uses economic metrics to understand what the demand environment also looks like. So it's almost like a backup to what we just saw in the first index. And this particular one is also giving us some of those same signals where we see automotive production demand a little bit stronger, perhaps through the first part of the year, maybe Q1, but then kind of softening mid-year before it kind of recovers and comes right back up. Now it's going to feel like a fairly moderate, flat environment overall. But what we're watching is kind of what happens with the consumer spending side of things. We'll talk about that in a moment. Now, these models have a couple different scenarios and simulations that they run, and they'll look at what would happen if the Federal Reserve, for instance, started to increase interest rates rather than decrease interest rates. What would that do to the model? It also looks at what would happen if consumer spending fell off, what would happen if jobs and unemployment, if jobs got tighter and unemployment started to increase. And so it paints a picture and it looks at those scenarios and it's seeing a scenario on this downward bound range that looks like a fairly good dip. But if you look at it in context, it wouldn't look anything like any prior recession. So right now, the index itself and the model itself is not giving us any like recessionary signals. But what it isn't doing is giving us this, hyper growth like we'd like to see. We'd like to see really strong growth coming out of this. But if it does hit the back end of the forecast, as it shows here, it would be a strong demand environment. So if we're talking about 16 to 17 million units a year, the peak being somewhere around 18, trough being somewhere around 10, you're talking about an environment that looks like 16 and a half to 17 million units a year being moved. So it's still a pretty good demand environment, especially if we see it hit these levels on the back end of the curve late next year, maybe early in 2026. Now, this accuracy rate on this particular model is batting almost 99% 6 months out. So we have a lot of confidence in the front end of this curve. And so that's what we're watching the most. One of the key catalysts, and I've talked about it many times, is the notion of this K-shaped recovery. And I know as I talk to dealers around the country, they're telling me that this is really kind of playing out when they look at the showroom floors and what models are moving, what models aren't moving. I've talked about this before, but the big reason why I'm bringing it back up again is because we're starting to get inflation signals that are lower while incomes and wages stay pretty high. That gap between wage growth and between inflation is helping a lot of households in these lower income levels really start to dig out and start to change the way they spend money. And so what we think is going to happen is the best way to say it is that this range of household incomes from about 75,000 and under has been somewhat dormant. They've been stalled. They haven't been able to go spend on a lot of new discretionary types of items. And so they actually become activated and they get activated in 2025 if these trends continue. So you're talking about activating almost 78 million households. That really helps boost the used car market. It's also going to help boost some of the lower end economy range models in most fleets. So you're gonna see that activation. You should see more foot traffic, but some of it's going to be in this lower end. Now, in the upper end, we still have a tremendous amount of opportunity up here. Wage growth is very strong. Up until just recently, stock market performance has been great. Happens to be up today when I'm recording. And so you've got some good performance here. In addition, one of the things that we talk about in the briefing, if you read it, is the notion of the great wealth transfer. And we know that the baby boomer generation is passing on somewhere between 53 trillion and 83 trillion dollars over the next 20 years to younger generations. And when these younger generations get this income, many times they go crazy and they'll go out and they'll purchase a lot of vehicles. So watch for that. It comes sporadically. There's no way we can predict when the baby boomer generation is passing that wealth down, and we don't know exactly what the younger generations are going to be spending it on. But a lot of them, again, are going to go upgrade vehicles. They're going to get larger vehicles. If they've been dealing with a four door, 2 row, they may move to something that's a 4 door 3 row. And you get the idea. And sports cars will also do well with this wealth transfer. But just watch this. I think again the important aspect of this is at the top end continues to spend, but we may be seeing activation at the bottom end. Kind of tied to that again, this is the most important economic metric we watch for automotive demand, and it's inflation adjusted personal income. So when we strip out taxes and some of the essential spending items, we want to look at income growth and how strong that income growth is. So under the prior Trump administration, it was about 3.1%. Right now through Q4, we were trending right at 2.7% for the full year. So not bad. It's a little bit better than what we saw, in the 2010s and early in the 2020s. So it shows that, that income growth is accelerating a little bit. Not as good as 2023, but still that provides a pretty average demand environment, which won't be bad. Now for 25 and 26, I think these forecasts will change, but for now we're looking at right around 2% growth for both. For general economic activity, then Q4 was still coming in pretty hot. Consumer spending was about 80% of GDP in Q4, which is up from about 70% in a normal quarter. Government spending was still pretty high at almost 18%. So, in the new Trump administration, one of the things that they want to try and accomplish is to shift some of that government spending to get it back down in the 12 to 13% range and shift a lot of that spending over to the private sector. And if that happens, some of what you'll see an improvement in fleet sales because a lot of companies that have been sitting idle for the last 2 or 3 years will go ahead and work on unit replenishment and upgrading units. And you'll also see obviously the consumer sector continue to spend. Job growth should be stable, wage growth should be stable. So that's what we're looking at for 2027, 2024, sorry, and 2025. Still looking at around 2.7% growth for both. And so we think that that will continue, as we move in. Now, the Trump administration is setting 3% as their target growth rate, and whether they can hit it or not is another story. But at least that's what they're gunning for at the moment. So, well, I appreciate everyone listening in. Tune in for next month, and we'll do the next update. And until then, have a great month and stay safe. All right, take care. Bye bye.